Welcome back, you legends. I missed you all. I just came back from vacation. I had a wonderful time, but I did miss a lot of things, a lot of action in the stock market, and I missed all of you, of course. So let's get right into this video. This past week has all been about squeezing the shorts. A lot of short squeezes going on, a lot of risk taking, a lot of risk on moves in the market. We went from a full bearish look 4 weeks ago to a full bore bullish look this week. Semiconductor stocks as well as software application stocks were the stars in the last couple of weeks. Semiconductors, due to the fact that the CHIPS Act has actually finally passed through the Senate and the House, which gave a lot of chip stocks a really major boost. Consumer cyclicals did really well. Healthcare stocks did really well as well, especially the biotechs. Small caps, big caps, all of them had really nice rallies over the last couple of weeks. Payment services, credit services did really nicely as well. All of them had solid earnings. Despite the fact that we've been actually seeing signs of the economy slowing down, these payment companies have actually been putting in really solid results and even raising forecasts in the case of American Express, as well as the credit card companies MasterCard and Visa. So let's take a look at the different sectors in the market. The week closed green overall, with technology up 3.3%, leading the pack. Communication services and consumer cyclicals coming in at second place with 1.5% and 1.4% roughly. So all of these three sectors are full risk on sectors, and strength in these sectors indicates that there's been a renewed interest and a renewed appetite in risk taking. Industrials were up less than a percentage point. Utilities, healthcare, financials, and consumer defensive were basically flat on the week. Basic materials and real estate were slightly down, and energy was the biggest loser, losing 5% after having that beautiful run last week. But there's been a bit of a turnaround in energy stocks after that massive employment report, the non-farm payrolls that came out Friday morning, coming in at twice the expectation, adding 500,000 plus jobs when the expectation was for 250,000. That's a massive beat. And unemployment came down from 3.6% to 3.5%, right? These are the numbers. They were significantly stronger than expected. So the economy, or at least the employment component of the economy, is significantly stronger than anybody expected. And this will put a lot of pressure on the Fed to raise interest rates at a faster rate. And this major beat on the unemployment and jobs numbers actually came in somewhat of a pie to the face of Jay Powell, who was talking earlier this week about how the Fed is actually very close to a neutral rate in terms of where the federal funds rate is sitting right now. They actually thought that this was neutral. This is no way neutral when the economy is adding 500,000 jobs in a single month. There's no way that the current interest rate is actually neutral at all. We're nowhere close to that. Not only that, but the Fed will need to raise rates beyond neutral into a more restrictive level to actually rein in inflation, because this is really bad news, guys. 0.5 percentage point up on average hourly earnings just in July. On an annual rate, that comes to about 6%. So that's 6% in core inflation, because earnings, guys, always translate into inflation because people spend what they earn. So the fear now is that we're actually approaching a wage price spiral where wages and prices start sort of racing each other to the upside. As people get bigger paychecks, businesses tend to raise prices, okay? So all in all, this is really bad news for the Fed pivot narrative, where people were expecting the Fed to possibly pause after September and start cutting rates into early next year. This definitely throws a wrench into that thesis. And it's really interesting, guys, because as jobs have actually been improving, other parts of the economy have actually been falling apart. There's actually a very well documented phenomena after pandemics where the economy actually begins to slow down while employment improves. And there's a very good reason for that I don't see anybody talking about. This is actually an area of expertise of mine, because this is my background. My background is in preventive medicine, pandemics, public health, infectious diseases, and that sort of thing. So I've actually studied this extensively. And what tends to happen after pandemics is that a lot of the workforce get sucked out of the market. Unfortunately, a lot of people pass away due to the diseases. A lot of other people actually lose the ability to work because of deteriorating health. And a lot of other people actually end up quitting their jobs out of fear. In fact, most of them will never go back to work ever. So this is a permanent shift in employment. The jobs market will remain tight for years to come, perhaps even a decade or so. And this will lead to wages moving up, which is very good news actually. It's actually good news. It's not bad news. Real inflation adjusted wages have actually been stagnating, and it's absolutely possible for the economy to enter a recession even as unemployment is low, despite what we've all been hearing on the news and despite what the so-called experts have been saying, as well as the White House. The economy can in fact contract even with employment remaining very strong. It happened after the Black Plague over 500 years ago. It happened after the Spanish flu. It really happened after every major pandemic. There's a shortage of workers, wages go up, and the economy slows down because there's not enough workers to produce things, right? So productivity goes down and wages go up at the same time. And that's how we get stagflation, which is a stagnant or shrinking economy with high inflation.
The COVID-19 pandemic has wholly altered how society operates, from the economy to education to people's daily interactions. It led to one of the worst U.S. recessions in history, leaving millions of people without jobs. Yet, as businesses open back up and people return to their pre-pandemic habits, employment levels aren't following. The United States is experiencing one of the worst labor shortages in decades that no one could have ever anticipated.
While the plague, by any measurement, was a horrific event, there was some upsides for the lower stratosphere of society. The rapid decline of human lives during the plague made human labor much more scarce. The Black Plague was devastating to the human population but had no effects on the land or physical infrastructures. With less human labor around, landowning nobility faced the question of who would work their lands. Landowners and nobility across England had to compete with each other to convince the remaining laborers to remain or to poach laborers from each other. English workers demanded and received meat pies and ale as part of their compensation. However, noblemen across Europe didn't sit idly by as their fortunes shrank. They quickly rallied the local government to take action to protect the pre-plague status quo, especially when it came to wages. For the laborers in Western Europe and certain parts of the Islamic world, who benefited from the increase in real wages and living conditions as a result of a scarcity in labor due to the plague, they enjoyed luxuries that they previously lacked, such as increased meat consumption. Increased wealth of the laborers resulted in inflation, as one contemporary noted. In spite of there being plenty of everything, it was all twice as expensive. Household equipment and foodstuff, as well as merchandise, hired labor, farm workers, and servants. The only exception was property and houses, of which there is a glut to this day.
Now let's jump into the daily chart for the S&P 500. The S&P 500 has actually been on a massive tear ever since putting in that low back here on the 17th of June. It did in fact form a double top right here, which ended up being a bear trap because we never actually broke the lows right here. And we had this massive gap and a run to the upside. We're now slamming into major resistance levels, right? We are trading around this consolidation level right here of $412 to $417. I still expect the S&P 500 to actually have one last move to the upside, but I do not expect it to break the $429 level, and there's a good reason for that. And that's to do with statistics. If we look at the historical performance of the S&P 500 in midterm election years, we do tend to see this rally towards the end of July and beginning of August. But this rally has never in the history of the stock market ever broken above the May highs, right? Let's take a look at every single example here. Second year new Democratic president, right there. We set a high right here, significantly below the high of May. Democratic president midterm years in the purple right here in August. We actually never break above the June highs, let alone the May highs. All midterm years, we never end up breaking the June highs, let alone the May highs. And then we have first term midterm years in the green right here in August. We never end up breaking the June highs, let alone the May highs. So far in the year, we've actually come super close to breaking the highs of June. Right here, when we put that high at $417.5 on the 2nd of June, we're getting really close to that. 3 out of the 4 examples that I showed you, we never actually cleared this high. In 1 out of the 4, we did clear this high, but we never broke above the May highs. So we're at a precipice here. This is pretty much the last leg of the rally. And we do have some negative catalysts coming in next week in the form of the CPI, Consumer Price Index, which is expected to come in hot, despite the fact that commodities have actually come down, oil prices have come down. They haven't come down enough, and structural inflation has been getting worse and worse. So even though headline inflation may come in below the last reading, the core inflation will likely be at a higher level. And the Fed uses the core inflation figure to chart future rate hikes. That's their preferred measure of inflation. And as long as core inflation remains hot and does not come down meaningfully, the Fed will have to keep raising rates. And that will put major pressure on the stock market. Now let's jump into the triple Qs and look at the Qs. This has been a massive rally to the upside. We've actually broken above this descending channel that we've been trading within for months and months. We haven't broken out of this channel since really the market top in November for the Nasdaq and the market top in the S&P 500 in January until last week. That was the first time that we've actually broken out of this descending channel. Now there's always 2 options when you see a break out of a channel like this. Number 1, it's a false break, right? And we come down immediately back into the channel. The second option, or the second possibility, is that this is a real break and we've actually formed a bottom right here. I tend to favor this thesis that we've actually made a bottom in the Nasdaq, not the S&P 500, but the Nasdaq. I believe that this is probably the bottom for the medium term, at least for the next few months. This is probably the bottom. We might actually see a retest of this bottom. We might even undercut this bottom slightly and then form a positive divergence on the PPO, on the MACD. And that would absolutely validate this as the true bottom. So I'm in that camp. I think that growth stocks are actually forming a bottom. They're in the midst of a bottoming process right now. I don't believe that the S&P 500 has bottomed quite yet. I still expect a test of this low into September, October right here. But remember guys, even if we see a pullback all the way to the June lows and even below the June lows, that can still be a bullish development as long as we form a higher low on the momentum. And I do think that we will probably form a lower low and touch this 200 weekly moving average. We've been waiting for a touch of the 200 weekly moving average for a while now. We have this gap right here at the $350 level. It makes a lot of sense for us to tag this moving average, undercut it slightly, hit 350 into September, possibly into October, and then see the real bull market begin, at least for a few months until the real recession hits. And we are seeing massive warning signs that a recession is coming, a deep recession. This is the 2-year yield divided by the 10-year yield. So this is the yield curve, the 210 yield curve, and it has inverted. And this is the deepest inversion of the yield curve that I've ever seen going back to 1988. This is the deepest inversion we have seen to date. Essentially, what this means, guys, is that bond traders are selling the 2-year bonds and they're buying the 10-year bonds. And when do bond traders do this? They tend to do this when they believe that the economy is going into recession fairly soon. So they dump the near-term bonds and they go into longer-term bonds. And when this happens, when you sell bonds, their yields go up, and when you buy bonds, their yields go down. Usually a 10-year note has a higher yield than a 2-year note because you're holding it for longer. There's more risk to holding this 10-year note. So the yields are usually higher. When the inverse happens, when the shorter term maturity notes give you a higher yield, it means that traders, bond traders, have zero faith in the economy and they believe the economy will crash. And every single time that we've actually had this inversion occur, we've had a major recession 6 to 18 months later. And this is no different, guys. I have no reason to believe that we will not enter a recession. In fact, the economy has already contracted in Q1 and Q2 slightly. It was negative 1.6% in Q1, negative 0.9% in Q2. And what I expect to happen, guys, is that the yield curve will probably cross back over in the next, let's say, 6 to 12 months. And when the yield curve starts to steepen again, right, when it starts to move up again, that's when we will see the actual, a real recession, right? Negative 2, 3, 4, 5, even 10% in GDP. And that's when the stock market crash will start. That's when the real or the second leg of the stock market crash will occur. Usually as the 2 to 10 year yield curve inverts, the stock market actually rallies throughout this inversion period. And as the yield curve begins to steepen, that's when the market tops and that's when we get the major sell-off. This happened every single time in the last 100 plus years. Right, this is 2006, the yield curve inverted right here in 2006. We did not have the stock market crash or the stock market top until around early 2008, right around here, when the yield curve started to steepen significantly. That's when the stock market topped. Again, in 2000, the yield curve inverted right here. In March of 2000, the stock market actually topped right around the same time. In fact, let me add the S&P 500 to this chart just so we can get a visual, right? The market topped right here in August of 2000, well into the inversion, right? The inversion occurred right here in February. We topped in August. And as the yield curve inverted, the stock market began to crash. Same thing here, really, guys. In 2008, the market topped in October of 2007 as the yield curve began to steepen. And so far, we've actually topped right around here in December, in January, December, okay? And we had the first inversion occur in April of 2022 this year. And now we've had the second leg of this inversion, a significantly deeper inversion. And that's when I expect the stock market to continue to rally and perhaps even hit new highs before selling off again. But before that occurs, I do expect another leg down in September, October, and then we get that massive rally and perhaps the final top. Maybe we get a double topping formation, right? A top in 2021 and a second top in 2023 with negative divergence on the momentum, right? Probably see something like that, double bottom right here in September, then a rally. We perhaps will break the highs, the 480 highs that we made earlier this year, overshoot those highs slightly, perhaps form a top in 2023, maybe around the middle of 2023, perhaps earlier than that, maybe in March, April, something like that. Form a negative divergence, right, where we don't form a higher high on the momentum, we form a lower high, and then we see that massive sell-off that will take us down all the way to the pandemic lows. Okay, that's my thesis right now. I think we will in fact visit those pandemic lows. I think the market will bottom somewhere in next year, perhaps. We will see. Those are still estimates, nothing set in stone. A lot of things can change, but that's my thesis as of right now. Let's jump into the Russell 2000, the small cap stocks. We have actually tagged the June highs right here on Friday. We haven't cleared the May highs. I do not think that we will clear the May highs. We have never cleared the May highs in midterm election years. In August, we always go back down, make a double bottom around September, October, and then we see that big end of year rally, the holiday rally. And in fact, on these smaller time frames, on the 2-hour chart for the IWM, we have actually been making lower highs on the momentum, even though we've been making higher highs on the chart. on the price action. Momentum has been significantly slowing down. Can we get another move to the upside, one final leg to the upside? Yes, that's possible, where we tag this trend line one last time and then see that sell-off begin. Usually, guys, if you look at the seasonality chart, we do tend to see this sell-off consistently in the last week of August, right? We do tend to see this sell-off into September, last week of August, right? It happened consistently in past midterm years where we top somewhere in mid-August and then we sell off towards the end of the month. And then we get another leg down towards the end of September and one last leg to the downside late October. In fact, during Democratic president midterm years, we tend to have a lower low in the back half of the year in September, October. That is still my expectation. I think we will break this low in September or in October. On the S&P 500, I think the Nasdaq will make a higher low, and that will mark the final and last bottom in the stock market before this massive rally in the last 3 months of the year. Now let's take a look at the 10-year yield. The 10-year yield had this massive push to the upside. Again, thanks to that really a strong, significantly stronger than expected jobs report, we had this massive move to the upside on the 10-year yield. We're actually nearing a bullish crossover on the PPO. We could even, in fact, make a higher high on the 10-year yield. That is still possible. We might make a higher high on the 10-year yield and then a lower high on the momentum, and that will probably mark the top in yields. And a move up on the 10-year yield will significantly impact stocks. It will put a lot of pressure on high multiple stocks, growth stocks, consumer discretionary, a lot of stocks in the Nasdaq and so on. And if we look at the dollar index remains in a bullish trend, right? It keeps moving up, making higher lows as it keeps moving up. We are still trading perfectly within this bullish channel. On these smaller time frames, on the 2-hour chart, we have already seen a significant divergence right here that marked the bottom in the dollar index, right, where we had a double bottom right here, and then again we had a double bottom right here in the dollar index. We had a higher low on the momentum indicator and then a lower low on the price action. This created a positive divergence and it marked the low in the dollar index, and since then we've been moving up. As the dollar index continues to perpetuate to the upside, this will put a lot of pressure on the stock market and will in fact accelerate that selling. That end of August, early September selling period will intensify as the dollar index keeps moving up. Now let's take a look at the semiconductor index. Right before I went on vacation, I did in fact call out that the semis have probably bottomed right here, and the reason for that, guys, is twofold. One, it's technical, right? We had this inverse head and shoulders formation. We had divergence on a lot of semi stocks. We did not get a divergence on the semiconductor index, but on individual stocks we did get a higher low on the momentum indicator on the PPO and a lower low on the price action, and that did mark a bottom. I also talked a lot about NVIDIA and AMD right here. In fact, I think I mentioned it 5 or 6 times in 6 different videos that this zone was a perfect zone to accumulate some NVIDIA and AMD shares, and so far it turned out to be the right call. I did in fact buy a lot of AMD shares, $100,000 worth of AMD shares right here at 77 bucks. So I got really lucky. I got really close to the bottom. This is an investment, guys. It's not a trade. I intend to hold those shares for 5-6 years. I do not intend to trade those shares. I'll be holding those shares for a long while. I also got into options right at the bottom. Again, I got really lucky. Price action ended up bottoming exactly at the lower edge of this channel. I did enter a option trade right here. I bought calls on AMD and I exited right here. I never got back in. So that was a short trade. I did miss this move to the upside. I expected more choppiness. I did not expect this massive move to the upside. And getting back to the semiconductor index, this was the first time that we broke through this resistance channel. Again, validating the thesis that this is probably the bottom. This does not mean, guys, that we could not test this low again. We will probably come really close to testing this low again. I did draw up this red line right here, and I did talk about it a few times. It represents bearishness below this line and bullishness above this line, right? So even if we pull back into September and then we tag this line, as long as we do not break below the line, or as long as we do not stay below the line for more than a few trading sessions, then this will absolutely confirm that this is the bottom, and it will validate this July low. And when we do get that, or if we do get that second test of the lows in September, October, I do intend to open a significant option position on AMD and NVIDIA, long dated leap calls on both NVIDIA and AMD. I did not open leap calls right here because, unlike stocks, guys, even if the stock does not end up breaking the low, if it comes really close to the low 2 to 3 months later, the leap options will actually be cheaper to buy here, even if we don't break the lows, right? The leap options will be cheaper to buy, and that's because of theta decay. It's the time premium that you pay to hold those options. So I'm just waiting for that time premium to continue to fade away, and that's when I plan to get into those leaps. I'll definitely talk more about it as we get close to that, and I will definitely post it in my Discord group in the trade alerts. If you're not aware, guys, I do have a Discord group. It's $20 a month, and it's a way for you guys to support me if you want to do that. You can buy me coffee once a week, and you get to see every single trade that I make, as well as a lot of charts and a lot of discussion about the economy, the stock market, etc. The link will be in the description below if you'd like to support me. That's one way you could do it. Getting back into the semiconductor stock, this is NVIDIA. I did talk a lot about NVIDIA right here. Again, I was talking about how this is an amazing opportunity to accumulate NVIDIA shares. I did not buy NVIDIA shares, I only bought AMD. AMD is my preferred semiconductor stock for a lot of reasons. Number one, it's cheaper than NVIDIA in terms of valuation, despite the fact that it's been growing revenues and profits at a faster rate. So it's a better performing company, it's growing faster than NVIDIA, and it's cheaper to buy. That's why I like AMD. I like NVIDIA as well, but I like AMD better. I will be buying NVIDIA options as we get a second test of this ascending channel, right towards the end of September, perhaps early October. I will take a look again at NVIDIA. We're getting super close to the upper edge of this descending channel. I do expect a rejection right around these levels. NVIDIA isn't expected to report earnings for a couple weeks, I think. If I remember correctly, NVIDIA will report earnings not this week, but the week after. So again, I would not be a buyer of NVIDIA right here, nor a buyer of NVIDIA options at these levels. There's a lot of implied volatility still baked into the options because of that earnings report coming in. And I do expect another dip or another test of the lows again later this year. That's when I will be loading up on NVIDIA options. I will be looking at the furthest expiration dates that I could buy, and I will be buying. Again, I'll be alerting everybody when I do that in the Discord group. Now let's take a look at GameStop. We've been following GameStop for a little bit now ahead of that split on the 22nd of July. We did expect this sell-off to occur right after the split, and it did happen, right? I was warning everybody to exit right around here before that split took place, because that is what tends to happen, guys. We tend to see a rally right ahead of a split, and then a sell-off right after the split is completed. But over the last week, we've been seeing significant FOMO, right? Fear of missing out. As the stock market has been getting super frothy, as the stock market has been getting into significant resistance levels, we've been seeing a lot of these meme stocks come back to life. Can it move higher from here? Yes, I think GameStop can still move higher. AMC again can still move higher. We've been talking about this 200 daily moving average for a while now. I've actually been covering AMC and calling for a touch of this 200 daily moving average. We've not only touched the 200 daily moving average, we've actually closed above it for the first time. For the first time since the stock market put in its highs earlier this year. So this is a significant development. It indicates a lot of FOMO into AMC, into GameStop, into these meme stocks. So where could it go next? It's really hard to say, but it could definitely go significantly higher from here. Why? We have this beautiful double bottom formation on the weekly chart right here on the momentum, with a lower high on the price action and then a higher low on the momentum. We have now broken through this neckline. If we stay above this neckline, guys, a full measured move would take AMC all the way to $50 again. So really close to the highs that we've seen last year. This is a super risky trade though. I'm not in this trade. The options are super expensive on AMC. That's why I do not trade it. I do not trade AMC or GameStop. But if you're in this trade and if you're hodling AMC and GameStop, this might be your ultimate target, $50. It could go higher. It might not even come close to that. It's really difficult to tell. My favorite meme stock at the moment is Bed Bath & Beyond. I absolutely love this double bottom formation on the daily chart with a significantly divergent high on the momentum indicator, the PPO. We still have a lot of room to run to the upside on Bed Bath & Beyond. We could easily hit $13, $12. And if we get a full bore short squeeze on this stock, remember guys, Bed Bath & Beyond has a 40% short interest. So 40% of the company's shares have actually been sold short. And as long as the price keeps moving up, it will keep putting more pressure on those short sellers to cover. And that will trigger a massive short squeeze. I am actually looking really closely at this stock to perhaps open a very tiny position because I honestly like the setup. I also like the fundamentals of the stock. The company is generating over $7 billion in yearly revenues, and the stock is priced at $600 million. Okay, the valuation of the company is at $600 million. So we could significantly move up from here. We could even 10x, 20x. This could go absolutely insane. It's a super high risk, high reward trade. I do not recommend that anybody get in this trade, but I will be putting in a very tiny position just to play this trade. I will probably take half off once we hit that $13 target, and I will let the rest ride to the upside. How high can this go? It's really up to anybody's guess, but if this stock is any indicator, this is HKD, the latest insane meme stock. It's a scam company. It's a worthless company from China, right? But look at how high it moved. It listed on the New York Stock Exchange back on the 15th of July. And since the stock has actually moved up 20,000%. That's 200x. So if you've somehow managed to get in at the bottom and you held to the top, a $1,000 investment would net $200,000 in profit, over $200,000 in profit. So this was an insane move to the upside. And I'm seeing a lot of buzz on BBBY, triple BY. Everywhere I looked, on Twitter, on Reddit, on StockTwits, everywhere. This might end up being this year's GameStop. It's impossible to tell. I like the setup. I like the valuation of the company. It is struggling. It is losing money, but I do not believe at all that this company will go bankrupt. I believe that it's in deep value territory at these levels. I would absolutely not be chasing this stock if it keeps moving up. I will just open a position when it makes sense, right around this $6.50 to $8 level. If I could get into it before it keeps ripping higher, that's what I will be doing. And we'll see what happens from there. It'll be a tiny position. Now let's take a look at crude oil. Crude oil has actually made a lower low. It formed a double top formation right here. And once we broke below this low right here, the bears took over. I think oil will probably still move to the downside. I have $85 as a intermediate target. I do not believe that oil will go down significantly more than that. Some people have actually been calling for $70 to $65 a barrel on oil. That's possible, but I do not think it's likely in the next couple of months. It might happen later in the year as the stock market bottoms and as inflation perhaps starts coming down meaningfully. I could see that, but in the next couple of months, I do not believe that will happen. My estimates at the moment are for oil to hit around $85, form a medium term bottom right here, and then see a move to the upside and perhaps get a rejection at these levels right here. And if you're an oil bear and you want to get a short position on oil, this might be the right entry. Right after it tags the low, bounces back up, fails to clear this resistance zone, and then comes back down, that might be the time to short oil. Now let's take a look at the XLE, the S&P 500 Energy ETF. We've actually talked about this divergence right here. We had this divergence on the 2-hour chart. We talked about it a lot, right? We had consecutive higher lows on the momentum with lower lows on the 2-hour chart. And this divergence ended up breaking to the upside. We hit that 200 period moving average on the 2-hour chart, and we've now moved back down. As oil makes that low around $85, I do see XLE perhaps testing these lows again or forming a higher low right around this level and trying to rally again. We will see what happens if oil actually continues to break below the $85 level and go into $65. This will put a lot of pressure on the energy sector. But if we see buyers step in, push oil back to $100, even break above $100 and stay there, I think that might be the signal to get back. Now let's take a look at this ratio chart. This is the XLY divided by the S&P 500. The XLY is the Consumer Discretionary S&P 500 ETF. And in this chart, it's divided by the broader S&P 500 index. And we've actually hit a significant resistance zone right here, bouncing off this 200 daily moving average. We could still see some consolidation, some choppiness here. One last move to the upside, tag this moving average, and then start moving back down. This is a great chart to look at if you want to figure out if the market is risk on or risk off. As long as XLY divided by the S&P 500 is moving up, right? As long as consumer discretionary is outperforming the broader market, that means that we are risk on. And as long as the ratio chart is moving to the downside, it means that we are risk off. Can we test the lows again? Yes, that's very possible. We might see a sell-off late August into September, into October. We will likely see the sell-off in late August into September, October, take us back to the lows, perhaps test the lows again right here, or even undercut the lows and then form a higher low on the momentum. And that would be the bottom in the market, in my opinion. Now, I have a few more charts that I want to talk about, guys. This chart is from Chiyuvaco Capital Management. Please check their YouTube channel. They do put out a weekly video that covers a lot of technical indicators as well as statistics that go back a long time. It's really valuable content, and I do follow them, and this chart is from their latest video. This is a chart of stocks above their 200 daily moving average on the New York Stock Exchange, and going back all the way into the late 80s, every single time we've touched this lower boundary right here at around 12.5%, and then we bounce back up and cleared the 38% level every single time we went from this low to clearing the green line. We've actually had the bottom in the market, right? It happened in 87, it happened in 1990. Again, it happened in the middle of 98. We never got that low in the 2000 bear market. We did break that low in 2008, and then we cleared this high in 2009 after we made that last low on the S&P 500, and again 2011 after that low, and again in 2020 after that low, right? So this is a very significant development. I'm not yet sure that we've actually bottomed. Again, I'm still waiting for that second leg of selling into September. It happened every single time in midterm election years. So I do not expect this year to be different. But again, there's a very significant distinction that I want to point out. right? Every single time we broken through the green line, we continue to move up. So we broke through significantly and then we continue to move up. It happened in 87, it happened in 1990. Again in 98 we had this significant break. Even though we've actually went back below the green line in 1999, we've actually had already put in the low earlier in 98. In 2008 we cleared the green line and then we had another break below, right? So that's important to keep in mind. And then when the bottom was in, we cleared the green line and then we stayed above it and then we kept moving up. 2011, same thing. 2018, same thing. 2020, same thing. So if we do see a rejection in the next couple of weeks and then we start moving down, this could very well be a false signal. And then if we clear this level again in October, November, that would probably mark the bottom. I have another chart for the S&P 500. Same thing really here, guys. In 2002, we broke below 12.5 and then we cleared the green line later in 2003 and then the bottom was already in. Again in 2009 when we cleared the green line, the bottom was in. Same thing 2011, same thing in 2018, same thing in 2020. But again guys, if we see a rejection right here at the green line and then we start moving back down, this could again be a false signal. But so far so good. And the way I'm interpreting this data, guys, is that we have probably put in the bottom on the Nasdaq, but not yet on the S&P 500. That's the way I'm interpreting the data. And if we take a look at the Nasdaq, again, same thing here. The bottom was in 2002. The bottom was in 2009. The bottom was in 2011. The bottom was in 2020. But in every single example here, we cleared the green line and then we stayed above it. We cleared the green line and then we kept pushing up. We cleared the green line and then we kept pushing up. If we see a rejection here, this could mean that this is a false signal, a bull trap. We will see. My read of the data again is that the Nasdaq has probably bottomed. Some stocks have probably bottomed. Consumer discretionary, Amazon, things like that have probably bottomed. But other sectors in the S&P 500 still have some more selling to come. Let's take a look at the Fear and Greed Index. It's sitting at neutral, hitting 50. It's been a long while since we've seen the Fear and Greed Index hit the 50 level. In fact, if we take a look at the timeline, the last time we were at 50 was right at the top of that bear market rally in late March, early April. We even hit 62 and then we saw that sell-off. So we can still see some more upside in the market. Again, I'm seeing a lot of hype around meme stocks. So I still think that we could see some more upside from these levels in the next couple of weeks and then the seasonal sell-off to start in the last week of August. On the market momentum, we're getting super close to the 125 daily moving average. This moving average has acted as very strong resistance throughout this bear market. Back here in January, again in February, and again in late March. And I still think that we could push through it. I do not think that we will clear 4,300. I think that's going to be an extremely tough resistance level for the market to clear. And we will probably see selling come in very strongly at that level. Stock price strength sitting at extreme greed. We're getting super close to that early April level when we had that top in the market. Stock price breadth is at extreme fear. The breadth has been continuously declining even though the stock market has been moving up. It's been a shallow rally led by a few names and some meme stocks, but the broader market has actually continued to see weakness, and this is a red flag. This is a major red flag. When you see the internals of the market continue to weaken as the market is rallying, it's one of the hallmarks of a bear market rally. The put to call ratio is sitting squarely in greedy territory, right? We've been making lower lows on the put to call ratio since we put in that bottom right here in late June. But overall, on the longer term trend, we've actually been putting in higher lows, and I do not expect us to break this April low at all. And again, this signals complacency as the rally has been strengthening. More people have been buying calls. We've been seeing less hedging. and this has been driving the market into super dangerous territory. Let's take a look at market volatility. Again, volatility has been declining significantly. In fact, if we take a look at the VIX chart, we've actually broken below this long-term bullish channel. This is the first time that we've done that since November of 2021, when we put that top in the Nasdaq and the top in a lot of stocks. This is the first time that we've broken below that level. Again, this is signaling somewhat of a regime change in the stock market. And it's one more data point that is pointing towards the bottom being in, at least in some stocks, not in the S&P 500 in my opinion, but at least in some stocks and some indices like the Nasdaq. This could still be a false break where we break below the trend line and then pop back right up and see significant selling into late August, mid-September. And if we see another rejection at this resistance line right here, this would again be another data point to look at that would signal that the market has probably bottomed. Another data point to look at, guys, is the bull-bear sentiment. The sentiment has been significantly moving towards the bullish side. Bearish sentiment has been significantly declining consecutively week after week. And as more and more traders become more bullish and less bearish, that usually marks a top. So it's a contrarian indicator, right? We had the highest bullish reading on the 10th of November in 2021. And if you guys remember, we actually topped, the market topped right around then. And again, the highest bearish reading in the last year was 59.4%. And it was at the end of April. And the market bottomed about a month later, a month and a half later. Moving into earnings, the beat data is sitting at 65%, so it's more than 50%, but it's significantly below the 77, 76, 75 level that we would like to see. So earnings have been significantly weakening for sure. Even though earnings expectations have actually come down, earnings are still showing weaker beat rate at 65%. So this is a 10% drop from the last earnings season. And again, it's signaling weakness in earnings. Next week, guys, we do have CPI coming in on Wednesday. So this is going to be a significant day for the market. I expect volatility to come in on the 10th. The consensus is 8.7%. Every single reading in the last, I think, 6 months has actually come in above the consensus forecast. So I do expect the CPI to come in above 8.7%. Even though commodities and oil have come down. Again, core inflation continues to climb, continues to accelerate, and the declines in commodities and oil have not been enough to lower this figure in any meaningful way. But still, again, seasonally speaking, guys, we tend to see the sell-off in August towards the last week of August. So the market could see some minor pullback after these figures come out. We also have the jobless claims coming in on Thursday and the 5-year inflation expectations coming in on Friday. So these figures could actually allow the market to pull back a little bit and then make that last move to the upside on the 3rd week of August, and then give all of those gains up in the last week of August and into September. That's all I have for you today, guys. Thank you so much for watching and supporting. I love you all, and I'll catch you in the next one. Bye-bye.
Oh, wow.